What if I told you the biggest reason most people stay broke isn't because they don't invest, but because they invest in the wrong order? People buy stocks, chase crypto, and watch finance videos all day while ignoring the fact that their credit cards are charging them 22% interest in the background. That's like trying to fill a bucket with holes in the bottom and wondering why it never fills up. Hey, I'm Nick, and today I'll show you the smartest order to build wealth, the same system financially successful people use to grow money without destroying themselves financially. Along the way, most people want the exciting stuff first. They want the next Tesla stock, the next Bitcoin rally, or some secret investment that promises to make them rich overnight. But real wealth isn't built on excitement. It's built on structure, discipline, and patience. Step 1. Build an emergency fund. Yeah, I know. It sounds boring. Nobody clicks on a financial video hoping to hear about savings accounts. But imagine your car breaks down tomorrow, or you lose your job, or you suddenly get hit with a huge medical bill. Without savings, you're forced into debt immediately. That's why an emergency fund matters so much. It gives you breathing room. It protects you from making desperate decisions when life punches you in the face. Start small. Save your first $1,000 as quickly as possible. Then build toward 1 month of expenses. Eventually aim for 3 to 6 months depending on your situation. You don't need perfection overnight. You just need momentum. Now let's talk about the mistake destroying millions of people financially. High-interest debt. If your credit card charges 22% interest while your investments earn 8%, you're losing money mathematically. Every month your debt grows faster than your investments. Paying off high-interest debt is basically a guaranteed return on your money. Think about it like this. Eliminating a 22% interest payment is like earning a guaranteed 22% return risk-free. Even the greatest investors in the world would love returns like that. So before trying to become a stock market genius, destroy toxic debt first. List all your debts and attack the highest interest rate aggressively while continuing minimum payments on the others. But there's one important exception. If your employer offers a retirement match, take it immediately. Why? Because it's free money. Imagine your company says, for every dollar you invest, we'll add more money on top. Ignoring that is like refusing a bonus at work. A company match can give you an instant 50% or even 100% return before your investments even move. That's why smart people contribute enough to get the full employer match. Then focus on eliminating debt completely. Once your emergency fund exists, your toxic debt is gone, and your employer match is secured. Now the real investing begins. This is where taxes become important. Most people completely ignore tax strategy, and that mistake can quietly cost them hundreds of thousands of dollars over time. Retirement accounts like IRAs and 401ks exist for a reason. They allow your money to grow with major tax advantages, meaning more of your wealth stays in your pocket instead of going to the government. And small differences matter more than people realize. A tiny annual fee or unnecessary taxes might not seem like much today, but over 30 years those small leaks can drain massive amounts of money from your future. That's also why HSAs are so powerful. Most people think an HSA is just for medical bills. Wrong. It's one of the best investment accounts available because it gives you 3 tax advantages: tax deductions when you contribute, tax-free growth while invested, and tax-free withdrawals for qualified medical expenses. That combination is incredibly powerful long-term. After maximizing those accounts, then you move into taxable investment accounts where you can buy stocks, ETFs, index funds, and other investments freely. But this is where people make huge mistakes. They think investing should feel exciting, so they constantly chase trends, panic during market crashes, and gamble on risky assets hoping to get rich fast. Real investing is usually boring. The people who quietly invest consistently for years often outperform the people constantly hunting for the next big thing, because wealth is not built through hype. It's built through discipline, consistency, and avoiding stupid financial mistakes year after year. So remember this order: emergency fund first, high-interest debt second, employer match third, tax-advantaged retirement accounts fourth, and only then focus heavily on taxable investing. That's how real wealth gets built while everyone else stays distracted chasing shortcuts. If This video helped you rethink money differently. Subscribe for more smart financial content and future investing strategies.